Welcome to another episode of the Domus podcast. I'm Tim Ruxton, and I'm joined today by Sarah Speed.
Thanks, Tim. Great to be here.
Sarah is here because Curtis's wife, is having a baby. So he'll be out for a little while, but Sarah, you flew in from Luxembourg today, did you not?
I did, absolutely. Very early.
Sarah and I are on the same team, the Client and Industry Solutions team.
Yeah, I have been with Domus for 15 years, so I have seen it from when it was a much smaller company than it is today. And I have started in the operations team, so I have a lot of experience actually dealing day to day with clients. And then over the last, I'd say, 8 years, I've been in the commercial team.
Well, I know you've got a great reputation in the marketplace, and your clients absolutely adore you. So thank you again for being here. I'm really glad you're here.
Thank you.
So as you mentioned, we're going to be talking about some complexities in the marketplace today, including some discussions around risk.
Yeah, we have Miriam, who is our Chief Risk and Compliance Officer, and she will be coming to give us a little bit of insight into managing risk and how we use data to manage risk in the context of the volatility that we're seeing in today's markets.
I think that's going to be a very good discussion. I'm interested to hear what she has to say about some of the issues that we're seeing in the marketplace today, and also where she thinks some of the risk is going to come from in the future, as well as just getting to know her a little bit, because there's another one we don't spend enough time with. So
Absolutely.
It's nice to have people in the room, isn't it? Yeah. If nothing else, the podcast is bringing people together. I heard you say something earlier, and I wonder if I ask you this question, if we're going to come to the same place. When you think of risk in your own life, what are some of the themes or some of the things that pop into your head?
Risk is something that you're always trying to balance. I've spent time in West Africa, and that meant basically packing everything up in Europe, getting rid of our apartment and moving to West Africa. And starting from scratch, starting a new business from scratch. But I think the fact that I've also trained as an auditor means that risk has always been part of my professional life. I'm good at considering the risks and balancing those out. But on the whole, I think I'm also keen to, take some risks.
I too took a risk in my career. I went from one state to the next. It's about a 2-hour drive, a very comfortable scenic drive, I might add. That's not where I thought you were going to go. I heard you mention earlier that later on today, you've got someone in your family taking their driving test.
Oh, yes.
So I was thinking, I've got twin 16-year-olds, a boy and a girl, and they just recently started driving, and I recently started sleeping less because of this. So I thought maybe that's where you're going to go with this, with the risk. But to your professional comparison, an auditor, you're looking for the financial risk, so you can point it out and have it corrected. That is not an easy job, and you have to sift through a lot of data to get to that point. And that data can be fragmented. It can be wrong. It can be, well, I guess that's what you're looking for, is the wrong fragmented data as an auditor. So I'm curious today, when Miriam comes on, she's going to talk a lot about the risk that she sees in the overall marketplace. You get to look at, from an auditing perspective, just isolated a little bit. She's got the added difficulty of looking at it unisolated and then preparing us, defending us. Do you see a comparison there?
I think from the days when I was an auditor to today, a lot has changed. And to be honest, I think we talk a lot about wanting more data, needing more data in order to make better decisions. I do wonder also if we end up with having too much data, and so that we can't see the wood for the trees. And that's something that I'd be interested in getting Miriam's perspective on.
That's something that's come up a lot recently, is everybody wants this mountain of data.
Yeah, but then what are we going to do with it?
What do you do with it? Great, you've got all your data. Now what?
You know what to do with it. Yeah. What's useful? Useful can be different for different people.
We're lucky to be joined now by our guest, Miriam Arntz. She is, as we mentioned, our Chief Risk and Compliance Officer. Really, really happy to have you here. Are you nervous? No, you don't look nervous. I've never seen her nervous. I'd love to try. But thank you again for being here. We have some things we want to talk to you about in terms of data and risk in the marketplace, but not yet. Let's find out about Miriam. So tell us about your history, your career?
So I've joined Domus about 3.5 years ago as Chief Risk and Compliance Officer. In my past, I've actually started off trading assets on a fixed income trading floor in investment banking. This is well before 2007. And then moved into asset liability management within insurance and asset management. And then joined AD because actually I loved the people, the business, and our clients. Brilliant.
I also want to know a little bit about just who is Miriam? What do you like to do when you're not geeking out on risk? You
I must admit, my favorite thing in the mornings is going for a run. I do like sort of 10 to 15K early in the mornings.
That's
And
10 or 15 in a row, right? Wow, can't do that.
there's something really, really beautiful about London before everybody wakes up.
Yeah.
Do you have your phones in, listening to music? What's on your playlist right now?
Typically, so appreciate, I grew up in the southeast of the United States.
I knew
Near
that.
New Orleans.
Yeah.
Yeah. So I do like rock music.
That's fantastic. Your ties to the Southeast United States. I already know the answer to this, but are you a fan of Mardi Gras?
I am a fan of Mardi Gras. I am a huge fan of the Saints as well.
She understands quarterbacking.
I do.
Yeah.
Curious, what drew you towards risk, towards working in that area of finance? Because you could have done. I saw your resume. You could have done any number of things. You were drawn to risk.
Yes.
Curious as to why.
Okay, so there is the other part of me, which is a complete quantitative geek. And I entirely love to understand deeply how to translate what happens in the world into a quantitative model, and then being able to bring that together and think about what does it mean for AD.
That's still a little geeky, so that's good. That's nice. I like to hear that. Should we switch the conversation a little bit to you and I were just talking about some of the data information, and I think you were trying to make a point, or you were making a very good point about how data is available, but also maybe a little bit, shall we say, dangerous. What are your thoughts on that?
Yeah, I think I was, alluding to the fact that data is a hot topic, certainly internally at Domus and in discussions with our clients. But I do wonder whether ultimately we become overwhelmed with data, and then how do we manage that?
So the way that I grew up in financial markets, and in particular with sort of more liquid and semi-liquid, right, assets, the reality is that it's about how the value add becomes how you use that data and how good you are at using that data, rather than being the person who ensures and makes it accurate. It's actually bringing that value add rather than just having the information. As soon as you master the accuracy of the data and having it available, it becomes more obvious how the models come together and how you actually make decisions easier.
I think also, if we look at the market more generally, there's a sort of view that, there's a standardization of data within the public markets, whereas in the private markets, it's very different.
Yes.
And we see with our clients that they're asking for all sorts of different data. It's much less standardized. What's your thoughts on that and how that can impact risk management?
It's an interesting one, and let's go back to just the journey that public markets have been on, right? So when I think back, when I started my career, even in public markets, in particular, over the counter, more on the liquid side markets, what we used to see is that standardized agreements like ISTAs and things like that were not yet in place. There's been a development towards standardized covenants, agreements, and master service agreements. And I think as you make data available and as clients ask for it, it sort of drives this conversation between the sort of two elements whereby we're going to start seeing standardization and clients going to ask for more and more data. But they need to start asking for that data to realize it's not standardized, it's not comparable, and therefore the market together, with everybody working together, needs to move towards such standards.
I suppose that's where we're in quite a interesting position, given that we're working with so many different clients, that we start to see where there are differences, where there are gaps, but also where clients are asking for the same thing. And so that's where things are starting to come together.
Do you have any concerns about, we talked about the public markets just now, but the private markets, the whole nature of their negotiation is that they're coming up with creative ideas to move money from the people that have it to the people who need it. And ways for them to repay it. So that the data they need is hard to standardize because when you add creativity to anything, standardization tends to fall apart. Is there more risk in having the data, not having the data, or is the risk inherent in the creativity that they're creating in the marketplace that is really ambiguous? We can't predict it.
So I would argue you can have both. You can have a level of standardization, which is just sort of, and even if part of your standardization, like you see it in public markets, are, so for example, 5 different day count methods, things like that, right? You can have a level of standardization combined with good creativity. Think, CLOs show a great level of creativity combined with standardization to make it comparable in the market. I entirely agree and appreciate that in particular in private markets, what you need are opportunities and levers to ensure that, for example, where a borrower may not be able to pay back in the expected timelines and maybe breaching covenants, that you can renegotiate those to avoid defaults, right? Entirely agreed. And that's a beauty of private markets that should for sure remain. However, being able to have more data at your fingertips, you might be able to tell much earlier when a borrower is unable to pay you back. You might be able to compare that much better. You might be able to see, so for example, if you think back 2007, who actually saw that there were all these homes in Florida that had no owner and that were just built one after the other, that were supposedly sold, but they were just standing empty, right? If you can get more data at your fingertips as a lender to actually see what's happening in those markets, you'll be able to act before things go wrong.
That's a fantastic answer. You're taking me back in time. I was working with CDOs back then. But you're right about, we had the information, we had the data, that things weren't quite right. We had nowhere to put it. We had nowhere to tell. Now we have some of those constructs in place that we can have the insight now to, if not predict, then prepare for what is to come. So that's a huge change in how the risk has transpired over the years. So that's a heck of a point, a really good point. I did want to follow up with something you said, that public and private can have standardization. I agree. I just think public maybe has had more chance to be ready for this, because private is not new. I will say that Domus was doing middle market and private debt long before it was cool. So we're trailblazers. I want everyone to know we were doing it a long time ago. But the default rates that we're seeing now are still higher on one side than the other. Though I think they're low. They're low, and the whole nature of private debt is that it's negotiated privately. There should be no defaults. You really have to mess up to default because of the creativity factor.
Correct.
But will standardization bring those even closer together and maybe even lower the default rates?
I would personally actually argue that default rates, due to where we ended up for the last 20 years, have been historically low and are probably lower than a competitive global economy might naturally see. So I actually would argue it's probably slightly the other way around, that we've seen historically low interest rates that drove way below default rates. Now, I totally agree that technically private markets have an absolute opportunity to have lower default rates than public markets. What we shouldn't underestimate, though, is that the ratings, so the credit quality of smaller businesses in the private market is typically lower than a lot of what you have in the public market. So you do need to start comparing apples with apples and not apples with oranges when it comes to that.
No, it's a lot of solid points there. In terms of ratings, I think Moody's just recently released a article study about just how many middle market loans are rated at a certain level or below, and possibly their free cash flow is correlated a little lower there. But to your point, historically low.
Yes.
Historically low. I think credit especially maybe gets a little bit of bad press because, bad press gets clicks, sells newspapers, however you want to say it. And the market's a little impatient. Do you see some of the things going on in the marketplace now? Is that a real risk or is this a blip? Is this an overreaction, I guess is what I'm trying to say.
Yeah, it's a great question. And I want to say it's a relatively complex answer, if that makes sense. What we are currently seeing in markets, there's always an element to credit risk, which I actually refer to as liquidity risk. So when, in particular, as soon as retail or semi-retail investors get involved, they will react to certain news, they will react to trends in the market much faster than your typical buy and hold pension investors that can ride out economic cycles. On the back of that, what you then would typically see is that they drive a level of liquidity risk. Now, that liquidity risk and the issues in that liquidity risk can turn into a credit risk because they pull their cash out too fast, which means there's a mass sale of credit, which means there's by definition an issue with spreads flow going out. Now, on the back of that, what we then typically see is that that's a blip unless there's a real economic basis for that. And I think we're currently seeing geopolitics, and then the question around what's happening with AI and how powerful can AI be that may impact those. Now, I appreciate that within the middle market, there's like in the United States, we're talking only 7 or 8% of the middle market are actually tech companies because, the US tech companies from the West Coast, they're actually some of the largest shares in the stock indices. But I think there is an element of that, and there's an element of risk of contagion within that we just need to watch and understand how that works.
That's the great answer. And it is a very complex answer, which is why we brought you on the show today.
Just linked to that, actually, with regards to retailization of products, and the investor base has changed for some of our clients, and that also therefore impacts data because we're talking about how those investors perceive what's happening in the market and how they react. But does that mean also therefore that the managers need to be thinking about how they communicate what data they're providing to those types of investors, because what they will be needing and looking for to have comfort is not necessarily the same as what the more traditional institutional investors are looking for. Would you agree with that?
Yeah, 100%. I actually think the whole concept is really interesting. So what we're seeing as an organization, and mindful, we also have a management company in Luxembourg, which of course sees a lot of the true investment risk management side of alternative funds. Yeah. We're seeing a lot more demands, much like UCITS funds, from retail investors or semi-retail investors. And we see regulators who typically are there to regulate on behalf of the retail investor. We see them as well being much more considerate on things like valuations and timely valuations, reporting around those and timely reporting around those. And then I'm sure you and I have seen that for very many years, is this whole question about how much liquidity does actually a fund that's available to retail customers need to maintain, and as a result, what should gating mechanisms look like, and what's acceptable for a retail investor and what wouldn't be. So I think it's quite interesting because it goes back to the question you asked earlier, which is around what does standardization look like and what would governance look like, and creativity around governance.
Yeah.
If you open that to retail customers, you are certainly defining a set of covenants that would be the minimum.
By broadening the investor base and allowing access to these products to new investors, we're driving further complexity in all of the data management and reporting that all of us need to do.
100%. And even understanding what that data would look like and being able to have it, create it, consider it. 100%.
Yeah.
So kind of to sum up some of the things we've been talking about here, I'd like to know, what is the one thing that keeps you up at night at Alter Domus that you worry that we can't deal with, or what's the worst thing that could happen? What's the thing that keeps you awake?
So the good news is I don't sleep enough for anything to keep me awake.
Forgot we talked about that.
To be honest, I think we're on a really exciting journey in private markets. We are an incredibly global company, which comes with serious opportunity in that space. I think embracing where data is going, embracing where AI is going, being open-minded to, AI is based on a model. It's going to be different than what tech in the past looked like. Embracing that, understanding that, has huge opportunities to foresee some of those economic challenges.
Are you leveraging any AI tools now to help you do your job?
Yes.
Yeah? You want to talk about it?
I can. So I've had the opportunity relatively early on, because I come from original code. So, financial models in the 90s were written in C code, not in spreadsheets. I've had the opportunity to work with some fantastic colleagues in the tech team who have been instrumental to helping me use Claude Code in Terminal. It's very exciting. We are running in some of those data limitations in private markets, which is fabulously interesting to see, because we are suddenly experiencing the challenges our clients are having, which brings it so much closer to us. It's really brilliant.
I don't want to imply that any of us are inexperienced, let's just say. But you, with your technically geeky background, where, let's see, look at the smile. Look at the smile on her face when I say geek. I love it. Did you find that to be an advantage?
Yeah.
And then how is that an advantage over someone like, say, ourselves, who maybe aren't as in tune with our geek as you are?
So for me, distributions, stochastic distributions, and understanding the opportunities of stochastic modeling are inherent to my entire career. And so for me, therefore, AI, which is by definition a distributed model rather than a deterministic outcome, is much clearer. I understand much better what the risks are. I understand how to manage them. I understand much better what the assumptions are, how to define your dependencies, how to think about the data that lives in that, what the limitations are. Those type of things, they're much easier to me. And I can sort of also see how AI, in particular, if MIT can get a quantitative AI model right rather than a language model. Remember, this is Claude, and he was a fantastic scientist, the man himself. But Claude Code is a language model, right? If we can get that right, the opportunity that has for our clients and financial markets to model some of that financial data much faster at the tip of your hands, rather than developing these massive stochastic models, it's going to be brilliant. It's going to be so exciting. We're going to really move forward in that.
Where do you think your role will be in 3 years' time if we bring you back to talk to us again?
I'm actually going to be looking forward to speaking to you in a year's time about this. So I think my job is going to improve in being data-led. So much more around understanding how we quantify even the operational risks in very quick time. So no more, manual reporting of things, but rather incidents get automatically raised through systems. And so you have sort of that opportunity for real-time operational intelligence and insight that you can actively manage at the same time. I think if we can get to that place, that'd be absolutely brilliant. And it massively reduces the amount of error that you have. It massively improves how we can see then prioritization of where our riskiest processes are and how we mitigate them, how we make them more technology-led, where's our riskiest areas within the tech space, and how do we manage those. The more data you can get out of those operational insights, I think will be absolutely important. At the same time, being able to deliver great data insights from the investment risk and financial risk perspective will be absolutely critical. I think it will help us internally manage our own data, but that operational intelligence for Domus then becomes sort of the ability for our clients to actively manage their financial risks, right? Because if we can get data absolutely right, our processes absolutely right, then that opportunity for our clients to have sort of data at the tip of their hands that they know is accurate because we run the right process is going to be really important.
Absolutely.
And that answer alone, I think, is maybe one of the best reasons to use Domus as a partner. We have Miriam, they don't. Thank you. I mean, we knew this was going to be a very complex conversation, and you made it so fun. I mean, this is great stuff. Yeah, we can't thank you enough for being on the program today. I don't want to wait 3 years to have you back.
I was going to say the same thing. I'm not sure we need to wait 3 years.
I don't think so. I don't think so. I think this is going to be one of those episodes that people are going to watch more than once. Thank you. Thank you very much for joining us today, Miriam. Another episode of the Domus podcast.